costing. Okay, let's see if this works. Job order costings. This is what we will learn about this week. We'll learn what job order costing is and how it's different from process costing that we will spend next week talking about. By the way, I know we're a Tuesday, Thursday class, but next Monday is a holiday. And I think, is Friday a campus holiday as well? Yeah, so Friday and Monday are both campus holidays, so just be aware of that. But we will be here Thursday of this week, as usual, and Tuesday of next week, so we are not directly impacted by the holiday. So next week we will learn about process costing, and we'll talk. We already know the three major components of production costs. What are the three types of costs that go into manufacturing and production? Direct material, direct labor, and manufacturing overhead, right? So we'll learn more about that, how we apply those costs to individual jobs. So if you're making a product for one customer, how do you keep track of the costs for that particular job? And we'll look at how these costs flow through the different inventory accounts. Does anybody remember what are the three different phases of inventory? Pretty sure I've mentioned it once or twice. Inventory starts as a raw material, right? If you're producing something, you start off with raw materials. Then once you start to make a product, it becomes a work in process. So it's still inventory, but now you're adding labor and you're adding overhead and sometimes even adding extra materials. And at this point, we call it work in process. And then when you finish making those goods, we call it finished goods. So those are the three phases of inventory, and we need to track that through the whole process. Remember how I told you keeping track of costs in manufacturing gets kind of tricky? You have to keep track of all those material costs, all those labor costs, all those overhead costs for every single job. And that's what we'll do this week. Excuse me, when it comes to overhead, we have to estimate what the overhead cost is going to be. And the reason we do that is so that we have something to work with. You don't actually know your overhead costs until after you're done making the product. And maybe not even until the end of the year when all of those overhead costs have come in. So we have a way of estimating the overhead cost so that we have a rough idea of what it's costing us for overhead. And then later on, we check to see how close were we and do we have to make an adjustment. All this allows us to compute the cost of individual jobs that we do for individual customers. And when we compare the overhead costs that we have applied, we can see, did we apply too much overhead, or maybe we under-applied and we didn't apply enough, okay? And the journal entries we will learn about, and also the same concept of job order costing can be applied in a non-manufacturing company. We will see how we could apply the same job order costing approach to making a movie, which is not a physical product, right? It's an intangible product, but you can still track the costs in a similar way. Just the terminology changes a little bit. Okay, so that's what we're going to focus on this week. It's not the easiest chapter, but I think you'll find it a little easier than last week. You can let me know what you think. So any questions at this point? Right? Okay, so job order costing versus process costing. If you are doing work for an individual client, then you would likely use job order costing. So if you've got, let's say you have, let's say you make custom-made automobiles, where every car you make is going to be different. Now, that's an interesting example I chose, actually. There is kind of a gray area. If you go to a dealership and buy a new car, they give you some options, right? You can customize it to some degree, but for the most part, cars are mass produced, right? So they'll make hundreds or thousands at a time that are identical to one another, but then they do give you some ability to customize. But if you went to a place that made, like, from scratch a custom automobile, they would keep track of the costs of that particular product, right? So they know how much to charge you and how much profit they make. On the other hand, if you go to the store and you buy a bag of M&Ms, not custom made, mass produced, right? When they make those M&Ms, they're not thinking, you know, what did Rene want in his M&Ms today, right? No, it's not customized, it's mass produced. And that's where process costing is involved. With process costing, you don't have individual jobs, you're just mass producing the same product over and over. And so you're keeping track of the costs of your processes, right? And that's what we'll do next week. So with job order costing, we use it when the products are made to order, meaning they're customized, or you can easily track the costs to a specific job for a specific customer. All right. Questions so far? Yeah, some examples. So let's think of companies that would be likely to use job order costing. What types of businesses would do customized work for individual clients?
Small online retailers.
Online retailers?
Small,
Okay.
smaller online.
Smaller ones, okay. Like an Etsy, where they customize the order to the individual customer's preference. Okay. What else? Restaurants, yeah. So they might have a menu, but they can customize the food to your particular preference, right? If you say, you know, make sure there's no olive oil in the dish, right? And they can customize it. True. What else? A jewelry store, yeah, they can make custom jewelry. Okay. Now, oh, Jordan.
I was thinking like medical stuff that's to your body, like retainers.
Okay, yeah, retainers, perfect example. You don't want somebody else's retainer, right? It's not gonna fit right, it might even do more damage than good. Right?
Hair salons?
Hair salons, that's an excellent example, right? Because you don't want just a generic haircut. You want a haircut that works for you, right? Perfect, so you all get the idea. On the other hand, what would be some products where process costing would be appropriate? Where it's mass produced with really very little customization. Okay. Furniture. Furniture can be customized, but we tend to just go to the store and pick out something that's already pre-made, right? We didn't get to decide on the color of the specification, whatever they have available. What else? With clothing? Yeah, right. It used to be like, I don't know, 150, 200 years ago, clothing was all customized. It was tailored to fit, or it was handmade at home, right? But now you go to the store and buy things off the rack. They are mass produced and not customized. If you go to a tailor, it's probably going to cost you more to get it altered than you paid for the original item, right? So we tended to buy things that were mass produced. Any other examples come to mind?
Does it have to be from a small business? Other than a cell phone?
A cell phone? Yeah, okay, those are mass produced, right? You can get some customization, there are certain colors, but usually you're limited to what variety they have in the store, right? You don't call up Apple and say, hey, could you make me a purple iPhone? No, they're not even gonna take your call, right? So, okay, you get the idea. This slide just shows how production fits into the whole grand scheme of things. So we see in a typical corporation, you've got a CEO at the top, they're over everything. And then you have multiple different functional areas of the business. One of those areas is production, where they actually make the products, if it's a manufacturing company. And in production, they have to receive and store whatever materials they're going to use to make the products. They have to design the products. Now, design is not always considered part of production. Sometimes it's considered an administrative part of the company. Sometimes it's considered manufacturing and production. So that's kind of a gray area. It depends on the company. Then we have the actual production, the factory or wherever they're actually making the product. And then we have another department that usually packages the item to make sure it's ready to be sold. So the finishing department. Okay, now let's see, let's start here. We know there are three components, right? You all told me direct materials, direct labor, and manufacturing overhead. All production-related costs fit into one of those three categories, right? If it's not a direct material, if it's not direct labor, then it's manufacturing overhead, if it has anything to do with production. So as I mentioned, the company has to receive its materials that it ordered from a supplier, and then it holds on to those materials until they're ready to be used in production. Here we have a sign company, and if they're printing the sign on vinyl, that would be the first material they'd have to get out of the storeroom, some vinyl, and they could then paint onto the vinyl. That might be a separate department. And then another department maybe adds little grommets, which you use to hang the sign. That would be part of the finishing process. And then we've got a finished good, right? So again, three phases of inventory: materials, work in process, which would be all of these, and then finished goods. However, inventory in all three of those phases are an asset, right? It becomes an expense when we sell it, right? And what do we call that expense? Cost of goods sold, right? So that's a lot to keep track of, right? You got the materials, you have this work in process, multiple departments here involved in work in process, and you actually have to, keep track of those costs, add your labor costs, add your overhead costs, till you finally have a finished product, and then it's still not considered an expense until you've sold the product. This manufacturing overhead here includes things like the plant supervisor's salary, housekeeping in the factory, maintenance in the factory, and then sometimes design and engineering. As I mentioned, sometimes that's not considered production. It's up to the company. But all of that goes into these overhead costs. And then again, the way we apply overhead is we need to estimate those costs and then later figure out how close our estimate was. Then we've got our period costs that have nothing to do with production, right? So that all falls under selling and administrative. So period costs include the executives' salaries, accounting and finance, marketing, HR, IT, all of that is really support. Not the actual production, it's something else. So that all falls into period costs. Any questions? Anything in clarification? Okay, let's keep going then. All right, we know this, right? We know that manufacturing costs can be divided into prime and conversion. What makes up prime costs? Exactly. Those are prime, they're the first costs that go into making the product because you always start with some materials. If you're making signs, can you start with overhead? Like overhead is things like your rent, your insurance, your electricity. How can you start there? You have to start with a piece of vinyl that's going to become the sign, right? So you have to start with your materials, add some labor, figure out how much overhead cost you have, and then you've got a finished product. So we start with the direct materials and the labor, and that's why they're called prime. But sometimes managers want to know, what was the conversion cost? What did it cost us to convert that piece of vinyl, that material, into a finished product? And how do we do that conversion? We add labor and we add overhead, right? So the conversion costs are the direct labor and manufacturing overhead. And as I've told you before, that means that direct labor falls into both prime and conversion categories, right? So you would never add them together. If you knew your prime costs, okay, you knew the prime costs and you wanted to figure out the total manufacturing costs, what would you need to add? The manufacturing overhead, exactly. And if you knew your conversion costs and you wanted to figure out your total manufacturing costs, what would you need to add?
Material.
The direct materials, exactly. Okay, so you get that. I think this is just, yeah, this is basically the same thing. I already told you that once we sell the product, then we have cost of goods sold, which is an expense. Period costs, they are all considered selling and administrative. They will be on the income statement, but they'll be further down. You think about the way the income statement is laid out, it's revenue minus your cost of goods sold equals your gross profit margin, right? So we start off with the production costs up top. Then from the gross profit margin, that's where we take out the other expenses, the period expenses, to get our net income. Okay, so we separate out the production related costs, they all go into cost of goods sold, and the other costs all go under selling and administrative. Okay, which means more work to keep all those separate. But that's why accountants get paid so well. All right, okay, so this is a grocery store, if I remember right. Yeah, grocery store, and they're thinking of adding home-cooked meals with a variety of options that customers can choose. So they're thinking about adding this as an additional service to their grocery store. Now, the customer can decide how they want their meal prepared, and then they just drive up and it's brought out to their car. If they were to offer this service, would it make more sense for them to use job order costing or process costing for this meal preparation service?
Job order.
What did we say? Process
Job order.
and job order, okay? So if the meal is just mass produced, if you don't really get a whole lot of choice, it's like today we're serving lasagna. You want lasagna? You can have lasagna. And then you're just mass producing lasagna. But if it's Today, we've got, I don't know, when making sandwiches, you could have this type or this type or this type, on this type of bread with these toppings or whatever, not toppings, what they call them, like ingredients. The more choice you're giving your customers, the more it becomes a customized product. And if you're customizing it, then you want to keep track. You know how restaurants charge you a whole bunch of money if you want avocado on something, like an extra $2 for a couple slices of avocado, right? Because avocados are a little on the expensive side because they're so perishable and there's a lot of manual labor involved. So that's the whole idea. The more that the cost varies for every particular order, the more sense it makes to use job order costing. So in this case, because of the variety of options, job order costing would give them a better idea of their actual costs for each order, which tells them their actual profits for each order, right? To know your profits, you have to take revenue minus costs. Do you want to know your costs? Do you know your profits? So, okay, I think that covers everything here. Any questions or comments? Okay, moving on. So we know direct materials can be directly traced to the product. We can say that this vinyl went into this sign, right? That's why we say direct. Direct labor, same idea. This person's 1 hour of work went into this product. So it's a direct material cost. Direct labor cost. And it's not just their hourly rate, but it also includes any payroll taxes and benefits related to the work that they're doing on the specific production. So if you've got a production worker who spends a day in training, or they're not actually making products, then that's indirect labor. You would track that separately, right? So with our production workers that are being paid hourly, we have to know how much of their work is going into actual production. And not only that, how much is going into each job. If they worked on 4 different jobs on the same day, how many hours did they work on each job? Because we need to know how much labor costs to apply on each job. And then everything else, right? Everything that is not direct materials and not direct labor is part of manufacturing overhead, which includes indirect materials, indirect labor, and everything else. What do we mean by indirect materials? They're materials that that's right, they're not directly related to a specific product, right? They did get used somehow in the production process. Maybe there are two things that come to mind. Sometimes materials get wasted. They end up being scrapped because somebody made a mistake or something went wrong. So that would fall into indirect materials because it didn't end up going into a specific product. But sometimes you've got material costs that it's just too hard to track how much went into that particular product. If it's something like, okay, let's say you're a baker and you make donuts and you put little sprinkles on the donuts. Well, what's the cost of those sprinkles? That's kind of hard to measure, right? So that'd be another case where we would just put that into the category of indirect material cost. It went onto the donut, but it's just too hard to track. Jordan.
Is overhead like always fixed costs?
No.
Like that.
Overhead does have both variable and fixed components.
So what's like a overhead cost that can be variable?
That would be one. The more you produce donuts, the more sprinkles you'll use, right? Even though you can't trace it to there's 2 cents worth of sprinkles on this particular donut. What we would do is say, okay, this month, for example, we think we're going to use $100 worth of these sprinkles. And then we'll just divide up that $100 of sprinkles over the total number of donuts we make. And that's how you apply your overhead costs. Take your estimate, apply it to your production, and then at the end of the period, you can look and see how much were our actual sprinkle costs. Sprinkles. Is that what it said? So that's how it works. Yeah, so that would be a variable. Direct material, a variable indirect material cost. That's part of overhead. What about indirect labor? What would that be? Training. Anytime the workers are not actually making the product, right? If they're doing maintenance on the machines, again, in training, the supervisor's salary in the factory is considered indirect labor because a supervisor is not making the product, right? So all of that falls into manufacturing overhead. All right, any questions on these terms? Can you have overhead that's not related to manufacturing? Yes, you can. So sometimes you'll see in the textbook, like here, it just says overhead, but we know that because they're talking about manufacturing, they really mean manufacturing overhead, right? It's not overhead for the corporate office because that would be a period cost. Right, so just keep that in mind. Mostly what we will be talking about is manufacturing overhead specifically. Okay, let's look through this example. So we've got a pizza restaurant. And we need to look at these different costs and see how they were classified and think about why. So here it says the chef's salary is direct labor. Why would that be?
Because it's actually prepping the food.
Yeah. The pizza restaurant, the chef is probably actually making pizza. Now, there might be some restaurants where you've got an executive chef who's not actually in the kitchen, right? They're designing menus or something like that. But typically the chef is actually involved in making the food. So that would be direct labor. What about the pepperoni and the pizza dough? It says those are both direct materials. Does that make sense? Okay. Then we've got electricity. That's way over here. Manufacturing, overhead, and other. So the electricity used to keep the lights on and keep the oven going, keep the mixer mixing, that is a cost of production, right? And it's not a material, it's not labor. So it would go into this other manufacturing overhead category. The manager's salary is here under indirect labor. Now, you could argue that because it's a pizza restaurant, the people managing the overall restaurant, that is, they're over administration and production, right? So just to keep things simple, let's just say this is the kitchen manager's salary, I guess. That would clearly be indirect labor, right? Because they're not actually making the pizza. They're just overseeing things. Okay, now here we have spices. Spices as indirect materials. Why would they be indirect and not direct?
Is it kind of like the sprinkles?
Exactly. It's too hard to track how much oregano did we put on this pizza? What's the cost of that, right? So it's easier just to throw it into overhead and we'll figure it out later. We'll apply those costs later. And then rent on the pizza restaurant would also be other manufacturing overhead, because that is the space where the food is being made, so it is a production related cost. Again, you could argue, well, if there's a dining room, then that part is not really production related, right? But anyways, you get the idea. Okay. So we've seen this before. The three parts of manufacturing costs, how they go from raw materials to work in process, which is all these steps in between, to finished goods. So what do we call direct labor and manufacturing overhead? What type of cost is that? Conversion, exactly. So it's the cost of taking these materials and converting them by applying labor and overhead into a finished good. So how do we keep track of all these costs, right? That can get complex, but of course there are methods that you can use to help keep things organized. What we have here is a materials requisition form. So if you work on the factory floor and you're ready to start working on a job, let's see, is there a job number? Job number MAC001. Then you would put in a requisition that says, okay, I need certain materials out of the storeroom so I can start working on this job. So you would put your name that you requested it on this date and who authorized you to get those materials from the storeroom.
The manager.
Yeah, the manager, right. So this would provide a paper trail, right? To make sure those materials are not just disappearing. We know who asked for them, who authorized it, what job they were used for, and it makes it hard for anybody to just accidentally walk out the door with a roll of vinyl, right? Unless they're in cahoots, that's true. Yeah, that's true. So you might need to check up on Tyler. I can't even read what it says. Okay, and then you see that every material that's being requested is specified. So they need some vinyl, they need one, I don't know, roll of vinyl, I guess. And it costs $300 per roll. So that's a total cost of $300. Two somethings of black ink at $50 each, that's $100, and so on. So we can see the total cost of materials that's being requested for this particular job, totaling up to $700 in materials. Now for accounting, this is important because this is how you track that these material costs came out of raw materials inventory, went into the next phase of inventory, which is called what?
Manufacturing.
So from raw materials, but there's a phase before finished goods, work in process. Okay, it's going out of the raw materials inventory account into work in process, right? And each of these different types of material has its own raw materials inventory account. And every job has its own work in process account. That way we keep everything organized and tracked. Okay, any questions on this materials requisition form? Okay. They did specify the date that they need it and a requisition number. So all of that helps for keeping track. Okay, now you can see with each of these materials accounts, like we have the vinyl account, the black ink account, etc. The accounting department is going to have to first journalize the transaction and then update the accounts in the ledger, right? So if originally at the beginning of the period, we had $1,000 worth of vinyl, and then we purchased another $10,000 worth of vinyl, but then $300 of vinyl got transferred from the storeroom onto the factory floor. And then we can see the remaining balance, how much vinyl we still should have in the storeroom, right? So we're tracking every single account. Now, it came out of the storeroom, but where did it go? All of these material costs, these are they're basically divided into two categories in this example. They started off with the vinyl and the ink and later added the grommets and the wood. Those were all materials that go into the sign, but that $300 of vinyl is part of this group of materials. And you see that got added to the work in process inventory account. And then later on, this is on a future date when they're ready to add the grommets and the wood, they added those costs also to the work in process inventory account for that particular job. Okay. Does that make sense? What do you think? Okay. All right. Then labor. We have to keep track of our labor costs for each particular job, right? So in this case, in the production department, we had two different workers. They each worked for an hour. They each get paid $15 an hour. And so that's a total of $30 of labor costs. But then once the product gets to the finishing department, that's where they have to add the grommets and the, what was the other thing? Grommets and the wood. So once it makes it to the finishing department, we've got two other workers that each spend an hour. They get a rate of $18 an hour. So that's $36 of labor costs. So far, the total labor costs related to this particular sign come out to $66. Here we can see the individual employees' time tickets where they keep track of the work that they've done. So I'll zoom in to make it a little easier to see. I'll just pick this one here. All right, so if we look at Ronnie or Rainey's time ticket, we see that on this date, they worked on 3 different jobs. This was the job we were looking at earlier. I guess they did both of the tasks that were needed at $18 each, and that's the $36 of labor we saw earlier. But you can see that the same person worked on this job for 5 hours and this job for 1 hour. So we have a record of all the work that they did and for which jobs. My daughter, I might have mentioned to you, she works in a law firm. Law firms charge by every 6-minute interval for work that they do on your case. Yep. So it's there, it comes out to 1/10 of an hour. So every 6 minutes, she has to think, okay, am I now working on a different client's case? If so, I need to start the clock ticking for this other client every 6 minutes.
What law does she?
Well, she's a paralegal and it's in an immigration law firm. And she might work on, 20 different clients' cases in one day. So it's a lot of keeping track of which case you're on. Okay, but anyways, so we have a record of what each employee did and for which jobs. So we can apply those labor costs to those specific jobs. All right, any questions on that? Okay. And so now those labor costs also get added into work in process inventory. So remember here, there were the original material costs and then some labor costs from the first department. Then there were some more material costs that they needed those grommets and wood in the finishing department. And here's the labor related to the finishing department. And so you see how the costs just get added to that job until the job is done. Right? Once you are done with the job, that's when you estimate your overhead for that job and you know the total cost. Okay? So that brings us to overhead. Before we get into overhead, is there anything that you would like clarified? Any questions out there? Okay, good. Well then, overhead. As I mentioned, you have to estimate the overhead, right? Because we don't know when this particular sign is done, we don't know what the electricity costs were for the factory that month and how much of that to apply to this particular job. There's no way for us to keep track of all that overhead and apply it to every job. So we have to use some estimates. There are three common approaches that we can use to estimate overhead. There's direct labor cost, there's direct labor hours, and machine hours. The direct labor costs, direct labor hours, and machine hours. And companies can use whichever method they think makes the most sense for that mission. If they tend to use a lot of labor in their production, then they can probably more accurately estimate overhead based on how much labor they used, either in hours of labor or total cost of labor. On the other hand, if they tend to use a lot of machines in their production, they might find they can more accurately estimate overhead by how much machine hours were used, how many machine hours were used for a particular product. So whatever approach a company is going to use, it uses that approach for all overhead, for all manufacturing overhead. You wouldn't decide differently for each job. It would be one set approach that you use all the time. In this case, it's direct labor dollars, or the direct labor cost is how they're applying overhead. So the way you do it is first you have to estimate what you think your overhead costs are going to be for the entire year. How would you do that? How would you estimate what your manufacturing overhead costs are going to be for next year? Exactly. You would look at the previous years and say, hey, last year we had $100,000 of manufacturing overhead. We think our production is going to be 10% higher. So then let's just add 10% and we'll say $110,000 of manufacturing overhead for the next year. So yes, you base it on your previous years. So once you have an estimate of your annual overhead, then you think, okay, what do we think our direct labor cost is going to be? And if you look at last year's direct labor costs, and then you make adjustments based on any changes you think are going to happen, you get your estimated direct labor costs for the next year. Again, if you're using machine hours or direct labor hours, it would be the same thing. You would just be estimating the number of hours. So since we're using direct labor cost in this case, we take the estimated overhead divided by the estimated activity that we just came up with, the cost, and that gives us a rate that we can apply to every single job. So when a job is done, remember how with this job, we saw that there were $66 of labor costs? There were 4 hours of labor, and it came out to $66 of labor costs. So once we have a rate, we would just multiply that rate by the labor cost for that job, and then we know how much overhead to apply. Okay. So you estimate the annual overhead, divide it by your estimated activity, that gives you a rate, multiply that rate by the actual activity. So this just puts some numbers in there. If their estimated overhead is $250,000 and they're expecting $100,000 of direct labor costs, that comes out to $2.50 of overhead for every $1 of direct labor cost. Okay? This is a really important formula. We will be using the same basic concept in process costing and in activity-based costing. So just get used to this formula. Estimated overhead divided by your estimated activity is your overhead rate. Okay, and then we could take the actual direct labor cost of $66, multiply it by that rate we just came up with, and now we know how much overhead to apply to this job. Now, at the end of the year, we can see how much actual overhead we have for the entire manufacturing department. And we can make adjustments to our overall numbers. We don't go back and revise individual jobs, but at least we can make an adjustment on the overall estimate that we applied for overhead. So now that we know our overhead estimate, we can add it to those material and labor costs, and we have the total cost for this particular job. Right? So we had these material costs, we had these labor costs, and now we add the estimated overhead. The way we journalize it, you see how there's a credit to manufacturing overhead and a debit to work in process inventory? And let's pick that apart. All the manufacturing overhead costs go into the same account. Everything that's related to production that is not direct materials and not direct labor all goes into this one manufacturing overhead account. And then when we apply it, like we're applying $165 of manufacturing overhead, we take it out of that account. We move that into the work in process inventory account for that particular job. What type of account would you say work in process inventory is? Is it an asset, a liability, or equity? It is an asset, right? Raw material is an asset, something we own. The work in process is also an asset, and the finished good also is an asset. So inventory at all phases remains an asset. What about manufacturing overhead? It's an asset too. Because it's, okay, let me think about this. Yeah, so the reason it's an asset is because it's going to be applied to our inventory and increase our inventory cost, right? And we know that that inventory is not going to become an expense until after it's sold, right? So every time that we incur some additional overhead costs, even if that cost is an expense, it's adding to our overall inventory costs. And then we take it out of that manufacturing overhead account when we put it into a specific work in process inventory account. Oh, okay, we have an exercise. All right, so get your exercise set ready. Exercise number 7. Okay, so we're going to practice this concept with estimating the overhead rate. I mentioned to you the 3 most common ways we do that are direct labor cost, right? Direct labor hours and machine hours. And here we have all 3. So this company estimated that their manufacturing overhead will be $750,000. First, we need to figure out what is our overhead rate based on 60,000 labor hours. Then what is our overhead rate if we base it on $1.5 million of labor costs? And then what is our overhead rate if we base it on 100,000 machine hours? So you'll get a different answer for each of these 3. Okay, any questions on what you need to do here? How are we going to do it? Divide? Yeah, exactly. So we're gonna have to take the overhead estimate of $750,000 and then divide by each activity. So go ahead and take a minute to do that. Okay. $12.50. You take the $750,000 and you divide it by 60,000 labor hours, it comes out to $12.50, right? Did anybody get anything different? Okay. What if we divide the 750,000 by the $1.5 million of labor costs? 0.5. What did I do? Okay. Oh, I see. 12.50. Okay. Yes, 0.5 or 50 cents per direct labor dollar, right? So for every dollar of direct labor cost, we will have 50 cents of overhead if we use labor expense. And then what about machine hours? What did you get? 750. So for every machine hour, we would apply $7.50 of manufacturing overhead. Okay, so we came up with 3 different rates. Which one should the company use? Okay, there's no answer to that. It depends. It's whatever the company thinks is the best, most accurate way to allocate their overhead. You would not combine these traditionally, although when we get into activity-based costing, you'll see you can actually use multiple different activities at the same time. But for this chapter and next week, you don't have to worry about that. So the company would just pick one approach, one of these 3, and use that to apply all of their manufacturing overheads. Any questions? Okay. All right, we're already a third of the way through the chapter. And we have another exercise, all right? This one, you're gonna have to do a little bit of number crunching on number 8. So we've got 3 jobs, right? 13, 14, and 15. We know the direct material and direct labor cost for each job. So if you like, you just copy and paste those right down into the table. Where the number crunching comes in here is that this company decided to assign overhead at $1.25 of overhead for each direct labor dollar. So for job 13, how are we going to figure out how much overhead to apply? Multiply? Close. The labor cost, right? Because in this case, they're basing it on the labor dollars, which would be the costs. And we have the labor costs here. It doesn't have a dollar sign, but we know it tells us these are the costs. So we know those are the labor costs. So in other words, we're just going to take 3,760. Once we have a calculator to work with here, the $3,760 of labor costs for that job multiplied by 1.25. That's $4,700 of overhead. And then we can just add that to the labor costs and the direct material costs to get a total. I got 16,020. Okay. So do the same thing for jobs 14 and 15. All right, so any questions about how we came up with the total costs here? Yes, Robert.
Is it just the direct materials plus direct overhead? Or how did you get to the total?
It's all 3.
Okay.
Materials, labor, and overhead. But tell me if I got any numbers wrong. Did I goof? Huh? No? Okay, good. Okay, so let's go back to the lecture. right? Here's a formula. It might look a little familiar. This is going to be really bad cinematography here, but that's all right. Okay, you're going to see this type of formula a lot, where you start with your beginning inventory, and this applies at all three phases of inventory. You see materials, work in process, and finished goods. They basically all follow the exact same formula, okay? But the general formula is you start with your beginning inventory, you add something to that, you subtract your ending inventory, and then that gives you your answer. Let's see how it applies at each phase. So your raw materials, well, you know how much raw material you have at the beginning of a period, right? And then you can add any new purchases of raw materials. At the end of the period, subtract how much raw materials you still have, and that tells you how much got transferred out on the factory floor, right? Meaning actually got used in production. Same thing with work in process inventory. If you start with how much is the cost of all the products you're making at the beginning of the period, right? Because work in process is products that we're making, but they're not done yet. So they're in between those other two phases. So how much work in process inventory do we have at the beginning of the period? Add your new production costs, which includes any additional material that you're adding, any labor that you're adding, and any overhead. Then you subtract your work in process cost at the end of the period, and it tells you the cost of the goods that you made during that period.
Are we gonna get into the lights on cycle?
No, I don't think there's any LIFO or FIFO in this chapter, because that really only applies to finished goods inventory. And we're learning more about the other, the intermediate part. Then again, the same formula over here. You look at how much finished goods you have at the beginning of the period. What is the cost of goods that were manufactured, which we just got over here? Subtract your finished goods at the end of the period, and that tells you the cost of the goods that you sold. Okay, so we can use that same formula at every stage of inventory. And really, the only difference we see here is that the production costs that we're adding to work in process inventory are comprised of direct materials, direct labor, and overhead. Now, let me elaborate on that a little bit, because I told you we start with materials, right? Like we start with the vinyl to make the sign. But at some point, you might have to add additional materials to that, not to create a new product, but just to add on to that product, right? So they started with the vinyl and the ink, and then later had to add the grommets, which are just little metal circles that you use to hang the sign, and wood. But those materials got added later in the production process. So during work in process inventory, you can add material, you can add labor, and overhead. You would add the overhead at the end. Once your product is done, you figure out the overhead cost, apply that like we just did in that last exercise, and then you can transfer it into finished goods. Okay? Any questions at all? Okay. So this is the same formula. This was for materials. Again, beginning plus purchases minus ending. We see the same thing here. Beginning materials plus what we purchased minus your ending materials tells you how much you used, right? But what I want to point out on this slide, there might be some cases where you don't know your ending inventory for materials. But if you know how much you used in production, you can figure it out. Because you can swap these last two in the formula if you need to. You can say, if you take the materials available for use right here, subtract out the materials used in production, that will tell you your ending raw materials inventory. Okay? This minus this equals that, but this minus this equals that. It works both ways. And there will be exercises and problems where you'll need to figure that out. And we see the same thing applies for work in process inventory. You can flip around. You can say manufacturing costs incurred minus cost of goods manufactured. Tells you ending work in process inventory. And you can also do it for finished goods. Okay. Any questions there? All right, let's look at what's going on here. We've got 3 different jobs. This job in their work in process inventory account. Here's another job. Here's another job. We see that direct material costs have been applied to all 3 jobs. Right, you can see that from the arrows here. Same thing with labor costs. Labor costs have been applied to all 3 jobs. Overhead costs have only been applied to these 2 jobs. Why not this one? Why have we not applied overhead to one of the jobs? When do we apply overhead? Can't apply the overhead until the job is done. Right? Whether we're using machine hours, or labor costs, we don't know what that is until the job is done. So if overhead has not been applied, because the job's still in process. So once it's done, then we can calculate using our overhead rate, how much to apply for that particular job. And then it becomes finished good. Now these 2, because they already have had the overhead added in there, notice that those costs have been transferred out of work in process inventory into finished goods inventory. And then when the product got sold, those costs get transferred out of cost of goods sold, out of finished goods inventory into cost of goods sold. And they stay in cost of goods sold until the end of the period when the company does its closing process. Remember that from financial accounting? Why would we close out cost of goods sold? So we can start it over at the beginning of the year. And we do that with all of the expense accounts, right? We close out revenue, we close out expenses, and we close out dividends. So since cost of goods sold is an expense account at the end of the period, we have to close it out and get it down to 0. So that is the process. Again, you see the raw materials go into work in process inventory along with the labor and the overhead. Out of work in process inventory, they go to finished goods inventory. When the item is sold, it goes to cost of goods sold and then gets closed out at the end of the year. A lot of steps, right? A lot to keep track of. Any questions at all? No? Okay. Let's practice. This is a good practice here for us. We'll do this one together. All right, let's do it live. See if I can just write directly on the screen. Let's see, search. Yeah, I think I can do it like this. Okay. Let me make it bigger. There we go. Can you see that okay? So we need to figure out which accounts we're going to record each of these transactions in. We bought some raw materials inventory. Which account would we record that in? A debit to raw materials inventory. Perfect. So I'm going to put A over here. Okay. Then B, factory wage expense incurred. In other words, it's the end of the payroll period. We calculated how much our factory workers worked. Where would we record that factory wage expense? Factory wage expense. Okay. Would it be a debit or credit? Debit. That's right, because we debit expenses when they go up. Let's see, do I have to? I think every time I have to go to text box. Okay, so B is going to go here. All right, now we issued some raw materials inventory to a particular job. So how would we do that?
Working.
So I'm sorry, credit to where? Yeah, we'll credit the raw materials inventory account because it has to come out of there. Insert. See, I wish there was a shortcut for this. I think there is though. What's that? Okay, so we're gonna have to credit, we're gonna have to take those costs out of the raw materials inventory account, and then where do we put them? To work in process inventory, that's right. Actually, you know what? Maybe there's a way I can do this in Zoom. Let's see. Oh, annotation. Annotate. Let's see if this is easier. Okay. Let's go to D. We allocate some of the factory wages to a particular job. How would we do that? Credit the expense. Okay, that's right. So it's going to come out of factory wage expense. Oh, that's better. Okay. And then what do we do? It is. It's going into work in process inventory. Just like the materials went into that account, so will the labor costs. Okay, then we have E, factory wage allocated to overhead. How do we do that? Okay, so it's going to go into manufacturing overhead. And where is it coming from? It was also factory wage expense, right? So some of those worker wages were for direct labor, that went into work in process. Some was indirect labor, that went into manufacturing overhead. Remember I said that manufacturing overhead is the account where all of the costs go that are related to production that are not direct material or direct labor. So they just all go in there. And then when a job is done, we take a certain amount of that manufacturing overhead and apply it to that job. So any questions on that? Okay, F, we completed the job. So now what do we do? Was that? Yes, no, it's not. Yes, it's finished goods. So we are going to take those costs out of work in process inventory from that job, and it's now finished goods. Now the job has been sold. What do we do? We're going to debit cost of goods sold and credit finished goods inventory. All right. So that's the process. We have to first, any materials that come in, they become raw materials inventory, right? Any labor that occurs, if we don't know immediately where to apply it to, it just goes into factory labor or factory wage expense account. And then we allocate those material costs and those labor head costs, labor head? That's not a word. We allocate those material costs and those labor costs to the work in process for that particular job, right? And then any indirect labor and indirect materials go into manufacturing overhead. And then at the end of the job, when we know how much overhead to apply, we take it out of there. They didn't have us do that in this case.
Does your credit card equal your debit from this number? Because A and B don't have the offset.
Well, they do, so they would, for B, it would be factory wages payable, probably, and we don't have that option here. And for the inventory, it'd probably be accounts payable. But yeah, good thinking there. And they didn't have us allocate overhead to the job for some reason, but normally we would do that when the job was completed. We would take some of this manufacturing overhead and we would add that to the work in process inventory. So you get the idea, it's supposed to be over there. All right, so I hope that helps illustrate these steps, okay, as it goes from raw materials and factory wage expenses into work in process inventory. Then when the job is done and you add your overhead costs, you put it into finished goods. And when you sell the goods, it goes into cost of goods sold. And that is the whole process. Okay, any questions? Oops. Okay, now I have to stop annotating. Oh, nice. Okay. Now I have to erase my screen. There is an option for that. Oh, it was probably right there. We'll just do it this way. Okay, that works. Oh, okay, I think we're good. So again, this is the formula that we've seen before. The way you come up with your overhead rate, you need to estimate your annual overhead, you're fine. Does that work? Will this work? Yeah, okay. So estimate what your overhead is, what you think it's going to be, or what you budget it to be. Pick your activity. What were the 3 activities we can use to estimate our overhead rate? Yeah, so direct labor costs, direct labor hours, and machine hours, right? So we pick one of those 3 as our activity, estimate how much of that we think we will have for the year. So then we take our estimated overhead, divided by the estimated activity, and we get our overhead rate, right? Which we can then apply to every job at the end of the job. So let's look at this process. This company, let's see. Yeah, this is how they calculated their estimated overhead. You see, they broke it down into all these different categories that are all part of the manufacturing overhead costs. And they added them all together and came up with $250,000 as their estimated overhead for the year. They also estimated $100,000 of labor costs. So we take the estimated overhead divided by the estimated activity to get $2.50 per dollar of direct labor. Then we can apply it. When a job is done, we take the direct labor cost for that job, multiply it by our rate. In this case, we get $165 of overhead. And then what we're doing at that point is we're taking that $165 out of the manufacturing overhead account and we're moving it into work in process inventory for that particular job. Okay. I always think of manufacturing overhead as a big bucket where we just keep putting in our costs, our inventory, or not, our insurance, our rent, our factory supervisor, our indirect labor, all of that just goes into this big bucket. And when we get to the end of the job, we scoop a certain amount out of that bucket to apply to that job based on our overhead rate. Okay, so, now this points out that the actual overhead cost is usually going to be different from whatever you thought it was going to be, right? Because it's really hard to estimate precisely to the penny what your overhead costs are going to be. In this case, we see that the company thought that they'd have $250,000 of overhead, and they actually had more than that. Right? The actual overhead cost was higher than what they had estimated. So they have under-applied their overhead. So what you do then at the end of the year is you just make an adjustment to your cost of goods sold and your manufacturing overhead account. Just one adjustment. You don't have to go back and adjust every single job. What we see here is just a visual representation of raw materials, a work in process, a finished good, and then an item that's been sold and is now an expense. I always wondered about this picture. I have a friend, his whole career has been in the sign making industry. So I showed him this picture. I said, what's going on here? Did he get his tie stuck in the machine or what? And he said, no, he's probably checking the alignment to make sure the sign is properly aligned.
On the estimation, does it matter? And if you're, so it doesn't matter if they're like.
Well, you want it to be as close as possible so that as the year is going by, you have a good idea of what the overhead costs are for every job. But if you're off by 5 or 10%, it's not going to be the end of the world.
They just typically don't do over or
Right. Yeah, you would try to make it as accurate as you can within reason. Yeah, and then we'll practice actually adjusting it. There's some different ways to do that. Okay, so we have 10 minutes before the break. Let me walk you through this. This is a busy slide. There's a lot going on here. But when you know what you're looking for, it actually makes sense. I'll make it a little bigger. Here we have 3 jobs. No, yeah, 3 jobs. It's going to be good enough. Move these out of the way. Okay. Let's see what's going on with these 3 jobs. In fact, let's start with this job. This was the job that we saw examples for earlier. There were $700 of material costs, $66 of labor, and $165 of manufacturing overhead, totaling $931 of costs for that particular job. So we know exactly what costs are associated with that job and that customer. Now, at the beginning of the period, if we had not yet started on this job, then we would have had 0 work in process inventory costs, right? Because we haven't even started yet. And then if we finished it during this period, we saw that there were $931 of total costs. We can add that to the 0 beginning work in process inventory and see the total cost for that job was $931. Okay? Now, ending work in process inventory, it says is also 0. So that means at the end of the period, there's nothing left in process for this job. It's all complete. So the cost of goods manufactured, you can take the 931 minus the 0 ending work in process inventory, and it's still $931. So we can see by looking at the numbers exactly what happened with this job and where it's at in the process. We know it's complete. Let's look at another job for comparison. This one, again, we see the different production costs. So there were $725 of production costs added during this period. But in this case, they were already working on this job in the last period. So in the last period, there were $1,000 of work in process costs. That becomes the beginning work in process cost for this period. They added another 725, and that means now there's a total of $1,725 associated with this job. Again, subtract the zero work in process inventory because it's all complete now. There's nothing remaining in process. And the total cost of these goods that they manufactured is the $1,725. Does that make sense? Okay. I know it's a lot of information, but if you just take it one step at a time, you see it kind of does make sense. And then for this job, they added $1,025 of costs. Again, they started with nothing. That is what they added. Now, look at what's different here. Ending work in process inventory is $1,025. Why would that be?
They haven't finished the job.
Exactly, they haven't finished the job yet, so it's still in process. So they have zero cost of goods manufactured because they've not been fully manufactured yet. Okay, it's kind of like forensic accounting. You get to look at the numbers and see, oh, what's going on here? Okay, any questions on this slide? Because the next slide is a continuation. All right, so what we see on top is the slide that we just saw. So let's zoom into this bottom part here. Oh, they're adding a fourth product as well. Let's start with this new product. This one here. Beginning finished goods inventory is $1,531. So what that tells us, at the beginning of the period, they already had that much finished goods for this product. And that's why we didn't see this product under work in process, because it was already finished in the last period. But it wasn't sold yet. So at the beginning of this period, we've got that much finished goods. They're adding no costs in this period because it's already finished, right? No more cost to add. Which means that they have this much available for sale. At the end of the period, there's nothing left in that product's finished goods inventory. Why not? They sold it. And so that 1,531 became cost of goods sold. Right? Because from finished goods inventory, when you sell the product, you then transfer those costs to cost of goods sold. This product, on the other hand, it had not been finished at the beginning of the period. It was still in process. But during the period, it became finished, and we now have $1,725 of goods manufactured that are available for sale. Did that product get sold?
No.
No, and we know that because it's still in finished goods inventory. Then there's our favorite product over here, that $931 product. Same thing. It was in process still at the beginning of the period, so there was no finished goods. It got finished during the period. And did this one get sold?
Yes.
Yes, because there's nothing in finished goods inventory. It's now in cost of goods sold. And then there's one more product here. Yeah, there we go. Okay, that one's all zeros. So that one, let's see what's going on with that one. It's still in process. This TJR 441 was not completely manufactured yet. So since this first category is finished goods inventory on this table. Well, it's not finished yet. So that's why it's all zeros. Okay? So you can imagine in a company that's making multiple products at the same time, and it's using job order costing, so the accountants are having to keep track of all these different costs for every single product at every phase of inventory, it gets a little complicated, right? And it makes sense if you take the time to look closely at the numbers, but it can seem a little overwhelming at times. All right, what questions are out there?
Have you ever had a job? Have you ever worked in managerial accounting before? No? That's a smart person.
I mean, you know, I wouldn't object to doing it. It'd be kind of an interesting experience, but no, my background was personal finance. So only for a couple months did I ever have accounting responsibility other than for my own like small businesses. So here, if we put things together, we take the beginning, finished goods, and work in process of every product. We can put them all on one table, add up, get a total beginning cost for all 4 products. We can see what direct materials we added for all 4 products, or at least 3 of them. Direct labor cost, overhead, and we can add up and get a total in each of those categories. We can also add up the total costs that were added, or that we started with or were added. And then we can see the status. So this product has been sold and the costs are in cost of goods sold. This product is finished but not sold yet, right? So it's still in finished goods inventory. This product also was sold, cost of goods sold. This one has not been finished, which is why it's still in work in process inventory. Everything has a purpose, right? Every number is there for a reason. And you just have to dig a little bit sometimes to understand what the reason is. Okay, well, we are about at break time. So if there are no questions, let's go ahead and start our break. See you at 2:50.